Hello, welcome back. We're taking a look at Daqo New Energy, a Chinese company. It's a semiconductor equipment and materials industry company, as you'll see here. Sector is technology. And as you'll see, it manufactures and sells polysilicon to photovoltaic products in the People's Republic of China. Interesting one. And we're going to be taking a look at the financials as we usually do here. This is a company that's suggested by one of our subscribers, and it's a subscriber that is a conservative one, which I love to see because I'm also a pretty conservative investor. And you will see here that the bet of the stock is 0.774, which means that it's less volatile than the overall market for the most part. Now let's take a little bit of a closer look at the stock analysis tool, which is preparing our data. This takes a little bit more time when we're handling non-US companies because it has to do the currency conversions and all that. The tool does a lot of stuff in the back end. So, and also it's running locally, by the way. So this is not running on an internet servers. So it's not optimized for performance. It's just running locally while I'm developing it. So what's going on here with Daqo New Energy Corp? You will see that in the last month, the company's stock price has been going down a little bit. But in the 1 year high was $92, so we're down 52%. Let's take a look at the max, and this is an old IPO. You will see that it has grown significantly, but for many years it was trading at similar ranges here. It had its breakthrough days over here when it really went like 1,000% higher, and now it's back down to some like 40s, 45 or so, 44. Now let's take a look at the financials though, because that's what matters at the very end. And this is a very low IPO PE. It's about 4.5, very low PE, and the price to free cash flow, that's also very low, and I love to see that. And they are also very close to each other, which is another good thing. The bad thing, outstanding shares. The company has been issuing quite some shares here. They are taking advantage of the stock price. They have been selling for the most part since 2017. You see, as it started increasing here in value, this is where they started to sell. They kept on selling though, and it makes a lot of sense to sell here for sure, because the board has to actually sell here. I mean, if I were the part of the board, I would definitely be selling here because I can make a lot of capital. And so, this can be a very good idea for the company to fund themselves, actually. But it can be bad for an investor who is holding stock. Maybe this is why they didn't want to do more, because they were already quite high in terms of issuing shares here. 40% in the last 5 years is nothing to sneeze at. That's a lot of extra stock. So the free cash flow to total liability is very low here. They basically need 1 year of free cash flow to pay all the total liabilities. It's like Facebook-esque. Or I don't know, like Apple-esque. very little liabilities compared to the free cash flow that they're making. Very nice. Good numbers here, but insane free cash flow growth. This probably has to do with non-cash items added back to the cash flow statement. We will examine that, of course. But still, it's positive numbers here. And total equity increasing, I'm assuming, has a lot to do with outstanding shares being more right now because the company issued more. And all the numbers are looking pretty nice here. Even this one, which is a little bit elevated, it's not that elevated, the price to book ratio, which I typically don't pay too much attention to tell you the truth, unless we're talking about financial companies, in which case they handle credit, and I do kinda need to take a look at the price to book ratio. It makes more sense. Yeah, here you will see that the debt to equity ratio is very low as well, 0.3, and the current ratio is 3.17, which is another good thing. Current ratio, in case you are not aware, is basically a ratio that divides the current assets of the company to its current liabilities. And by current we mean the 12-month assets, and by 12-month we mean the ones that can be liquidated very quickly in the next year. And 12-month liabilities is the short-term liabilities. This is a very handy way to know how many liabilities the company has in when you compare it to its assets for the short term. So if they can actually fulfill that for the short term just by using their assets, it's just a straight comparison. Very useful number to have that here. And next up, we're going to be taking a look at the financial statements. I want to see things in a little bit more detail here. And you will see that the company's revenue has been growing nicely, and 2021 has been a breakthrough year. You're kind of expecting it from this kind of company. It seems like semiconductors are the thing these days. And yeah, they seem to be increasing their revenues quite some lately. And the bottom line is important because, as you'll see here, the company used to be doing 100 million and now they're doing 756 million. That's a steep increase, even though they had some down years here. Now, we do want to take a little bit of a look at the balance sheet, of course. And typically, I want to examine the total assets, total liabilities, and total equity for the most part, unless I want to see something else, of course. Like the additional paid-in capital is very interesting as well, but we do know that the company is issuing shares, so you expect that. But little liabilities compared to the total assets, that's a small percentage here, which gives quite some good total equity here of almost 2.7 billion. The cash flow statement, you will see here that the net income of the company is, of course, top line, and then it's broken down to how this is attributed for the operating activities cash flow. And for the most part, you will see that this other non-cash item is what's causing the increase here in the operating activities cash flow for that year. It makes it much higher. This is a one-time thing, and this is why in the previous year it wasn't existent. And yeah, it's still increasing though, and the company does have some depreciation and amortization as well, which adds back to the free cash flow and extracts from the net income statement. Cash from investing, the company has been actually getting some investments here, and capital expenditures for the most part is what they are doing, and some acquisitions here. No, this is other investing activities, so they probably bought some purchases, some investments here. Okay, the net cash the net cash provided by financing activities here is positive, which means that the company has got a little bit of debt. They seem to be doing fine with debt, so I wouldn't be worried. And a little bit of cash here at the end of the period, and the free cash flow is increasing. We kind of saw why this is a little bit of the odd one out, and it gets increased by this other non-cash item. So you have to bear that in mind. This would be about maybe 400 for the most part. And next, we're going to examine our stock evaluation tool because the company looks nice, looks like they're doing better and have good numbers, but we need to also discover the value that it makes sense to pay for the company based on these numbers. And the revenue growth has been pretty good here. We had, for some reason, we're missing this one. Yeah, this is missing from the third-party data. But yeah, this is about 100% here, actually. So the revenue growth that we should be using here must be much lower than this, of course. This one, probably we should probably go a little bit lower than this for our high even. But I think I'm going to be using 10, 12, and 14 here. I think that makes a lot of sense. Of course, when you get your hands on the tool, you can try your own values as many as you like. The net income margin here, they did have it 8 and 12 here, so I am gonna use that 8, 12, and 15. Let's just go. And because some of these years have been pretty good here, and the free cash flow margin that I'm gonna be using, of course I'm gonna extract these ones, which were the odd one out. But because of them, I'm gonna be lowering it a little bit. So I'm gonna start at 60 and go 70 and 80 here. And the annual return that I typically want to make is 13%. Let's hit calculate. And as you'll see, for our medium estimates, we're close to the current price, yet a little bit lower. The low ones were far away. And our high ones, we're within our limits here. High ones being these ones, a revenue growth of 14%, 15% income margin, and free cash flow margin of 80%. So these are high estimates. Now, I think this one is a potentially interesting target. It may be a little bit more than I would like to get it at. I think I would like to have a little bit of a margin of safety here and get it at a little bit of a lower price. Maybe, I don't know, maybe 35 or so would be nice, potentially. And whether this will happen or not, I don't know, of course. But, you know, you can always make your own decision based on what you're seeing here and the whole analysis. It's not a bad company. It's doing fairly well, and I think they will keep doing well. But you have to be a little bit cautious about, you know, the price to pay today based on what they're doing and based on what they are projected to be doing in the future. So hopefully that was useful to watch for you and kind of helps you with your decisions. Thanks for the suggestion. Very interesting company. Good one. And please remember to leave a like and subscribe if you liked the video. And I'll see you in the very next one. In the meantime, take a look at this one that I made earlier, and it discusses a Canadian stock. We kind of take a look at other markets as well. So thanks for watching this one, and I'll see you soon. Bye-bye.